Imagine a world where the very foundation of your wealth, the currency resting in your bank account, and the stability of the supply chains that feed your city, are all being reprogrammed in real time by forces entirely beyond your control. We are currently standing at a terrifying but lucrative precipice, where the lines between domestic fiscal policy, global economic warfare, and technological disruption have blurred into a single, chaotic spectrum of risk and opportunity. The question you must ask yourself is not whether the storm of the century is coming, but whether you have the precise intellectual framework to see through the rain and position yourself before the masses. Realize what has happened. Hello, this is WarmInsight. Today, we're going to talk about geopolitical volatility and domestic policy shifts. Leaving a like and subscribing is a huge help to us. To understand the present reality and project the future of global markets, we must first look at the grand chessboard of global hegemony, a board that is currently undergoing its most radical transformation since the end of the Second World War. Right now, the global geopolitical landscape is increasingly fragmented, presenting an incredibly complex web of systemic risks and generational opportunities for sophisticated investors who refuse to rely on mainstream financial media. We are actively witnessing the rapid breakdown of the post-Cold War consensus, a period that was characterized by hyper-globalization, frictionless supply chains, and the unchallenged supremacy of Western financial institutions. That era is definitively over. The precarious United States and Iran ceasefire, a situation which has been accurately described by former President Trump as being on life support, serves as a primary glaring example of this new fragility. When we look at the Middle East, we aren't just looking at desert sands, religious conflicts, and oil wells. We are looking directly at the literal pulse of the global macroeconomic system. An escalation in this specific region doesn't just mean a few extra dollars paid at the neighborhood gas pump. It means a complete, structural recalibration of the geopolitical risk premium across every single asset class on Earth. To truly grasp the magnitude of this, we must delve deep into the history of energy, being deployed as an asymmetric weapon of statecraft. Let us travel back to the autumn of 1973. The world was forced to learn the incredibly painful lesson that crude oil is not merely a commodity traded on exchanges, but the very lifeblood of industrial civilization. During the Organization of Arab Petroleum Exporting Countries oil embargo, the sudden, politically motivated restriction of supply caused global oil prices to quadruple almost overnight. This singular geopolitical maneuver did not just cause a temporary market dip. It fundamentally altered the trajectory of the 20th century. It led to a grueling decade of economic stagflation, a terrifying paradox of high inflation combined with stagnant economic growth and rising unemployment that completely broke the back of the American middle class. It forced a massive, painful transition in the automotive industry from gas-guzzling land yachts to smaller, fuel-efficient vehicles. It fundamentally altered the physical landscape of national highways and ultimately forced the Federal Reserve, under the leadership of Paul Volcker, to hike interest rates to unprecedented double-digit levels, just to wring the inflation out of the system, causing massive collateral damage to the broader economy. Today, as we look at the data in 2026, we see the exact same shadows lengthening across the global economy. Geopolitical tensions, particularly the escalating friction with Iran and the constant proxy conflicts simmering in resource-rich regions, are keeping West Texas Intermediate crude oil prices artificially elevated. Despite weakening aggregate global demand, this current pricing structure isn't just a simple equation of immediate supply and daily consumer demand. It is a complex mathematical representation of fear. It is about the market's anticipation of a catastrophic breakdown in diplomacy when a major international ceasefire is openly acknowledged to be on life support. Institutional investors and sovereign wealth funds are effectively paying a massive premium for the distinct possibility of a total collapse in the flow of energy through critical maritime choke points like the Strait of Hormuz. Through this narrow body of water flows a massive percentage of the world's daily oil consumption. Even a temporary blockade or a disruption caused by asymmetric naval warfare would send shockwaves through the global supply chain, instantly elevating the geopolitical risk premium on all energy assets. This dynamic drives extreme volatility in global crude markets, immediately impacting inflation expectations worldwide and forcing central banks into an impossible corner, where they must choose between saving the currency from hyperinflation or saving the economy from a crushing recession. But the battle for the future of the global order isn't just being fought with barrels of oil or military hardware. It is being fought with the very concept of money itself. Concurrently, the United States government is actively devising aggressive, multi-tiered strategies to ensure the dollar's continued dominance. Amidst a period of profound economic turmoil, this desperate defense of the reserve currency status is a move that is being directly and systematically challenged by China's concerted, long-term efforts to bolster the global influence of the renminbi. This escalating currency rivalry is not merely a dry academic economic debate. It is the defining financial conflict of our era. It reflects a much broader, existential struggle for absolute global financial hegemony. The outcome of this silent war will have catastrophic implications for international trade flows, the valuation of global capital markets, and the long-term, structural stability of the entire international monetary system. To properly visualize the gravity of this situation, we must apply the concept of the Thucydides trap, a profound psychological and political theory, articulated by historians to describe the inherent, almost inevitable danger that occurs when a rapidly rising power threatens to displace an existing entrenched hegemon. Throughout recorded human history, this specific geopolitical dynamic has almost always led to devastating conflict. We saw a non-kinetic version of this transition during the early to mid-20th century when the British pound sterling, the undisputed sovereign of global trade, during the era of the British Empire, was slowly, methodically eclipsed by the American dollar. Following the devastation of World War II, that transition was not a smooth, gentlemanly handover of power. It involved the humiliating Suez Crisis, the rapid and chaotic collapse of colonial empires, and a total, fundamental rewriting of the rules of global trade. At the Bretton Woods Conference in 1944, at Bretton Woods, the United States leveraged its massive gold reserves and undamaged industrial base to force the world to peg their currencies to the dollar, establishing an exorbitant privilege that allowed America to run massive deficits without facing the immediate inflationary consequences that would destroy any other nation. Now we are watching the exact same historical script being performed, but the actors on the stage have changed, and the stakes are exponentially higher. China is not simply complaining about the dominance of the dollar. They are actively, aggressively building a parallel global financial architecture. They are constructing a digital Silk Road, backed by their cross-border interbank payment system, which is specifically designed to completely bypass the Western-controlled SWIFT banking apparatus. Every single time the United States utilizes the global reach of the dollar as a blunt instrument of foreign policy, through economic sanctions, it provides a massive, undeniable incentive for the rest of the developing world, the global South, to frantically look for an exit door. Nations are watching and realizing that holding their sovereign wealth in dollar-denominated assets is a massive geopolitical liability. If they ever disagree with Washington's foreign policy, this is the immense dual pressure the United States dollar index currently faces. It is caught in a vice grip between the federal government's desperate need to print money to fund massive domestic deficits and the rest of the world's accelerating desire to de-dollarize their foreign exchange reserves, aggressively buying physical gold to protect their national sovereignty. Let us now shift our analytical gaze from the macro global stage to the incredibly volatile internal domestic theater, because domestic policy decisions are increasingly, inextricably intertwined with these massive global forces. Take, for a prime example, the highly publicized political proposal to suspend the federal gas tax. On the surface, to the average voter and the financially uneducated consumer, this looks like a massive benevolent win. It looks like the government stepping in to provide immediate relief to the struggling working class. However, a deeper objective economic analysis reveals this policy as a dangerously reactive stance to global commodity shocks, rather than a strategic move toward proactive, long-term energy independence. This short-term fiscal measure, if it is actually enacted through the gridlock of the legislature, could temporarily ease localized inflationary pressures at the pump. But it does absolutely nothing to address the severe, underlying supply and demand imbalances that have been exacerbated by international conflicts and decades of underinvestment in domestic energy infrastructure. It is the economic equivalent of putting a cheap, plastic Band-Aid on a massive arterial bullet wound. To understand why governments repeatedly enact these destructive policies, we must dive into the fascinating history of price controls. We have to go all the way back to the year 301 during the reign of the Roman Emperor Diocletian, facing massive inflation caused by the continuous debasement of the silver denarius. To fund endless border wars, Diocletian issued the edict on maximum prices. He literally made it a capital offense, punishable by death, to sell goods above a government-mandated price. Did it work? Absolutely not. It was a catastrophic failure. Merchants simply pulled their goods from the open markets. Rather than sell at a loss, it created massive, sprawling black markets, destroyed the profit incentive for farmers, caused widespread localized famines, and fundamentally accelerated the collapse of the Roman middle class. The proposed gas tax suspension, while obviously less draconian, operates on the exact same flawed economic logic. By artificially lowering the price of gasoline, you actually stimulate more consumer demand at the exact moment. When global supply is constrained, this inevitably leads to worse shortages and ultimately higher prices down the road. It is a political theater designed to win elections, not a serious economic strategy designed to build national resilience. This brings us to a critical, unavoidable point regarding human psychology and behavioral economics, specifically the concept known as the affect heuristic. The current macro climate of severe political uncertainty and rapid policy flux is an incredibly fertile breeding ground for deeply ingrained cognitive biases and catastrophic retail investor panic. The human brain evolved to survive in small tribes on the savannah, not to objectively analyze complex global bond markets while being bombarded by a 24-hour news cycle. When the average person sees sensational, terrifying headlines surrounding assassination attempts on prominent political figures, or when they are subjected to highly divisive, emotionally charged arguments over controversial health inquiries, the brain literally stops processing information logically. The amygdala, the fear center of the brain, completely takes over, effectively shutting down the prefrontal cortex, which is the area responsible for long-term planning and rational portfolio allocation. This is the affect heuristic in action. It is a mental shortcut where your immediate, visceral emotions completely override any semblance of rational statistical analysis. Retail investors who are constantly driven by the twin psychological demons of the fear of missing out, or FOMO, and the paralyzing fear of loss, will predictably react impulsively to news of a proposed gas tax suspension. They will perceive it as a massive, fundamentally market-moving event. They will blindly, aggressively buy or sell related equities, without fully grasping the policy's incredibly limited actual impact on global price dynamics, or without understanding the massive, convoluted congressional hurdles the bill faces before it can even become law. They trade the headline, not the underlying reality. Think of the retail market as a massive herd of gazelles, grazing on an open, dangerous savanna. When one single gazelle on the edge of the herd senses a predator, or even just imagines a shadow in the grass, it bolts. Instantly, the entire massive herd follows in a blind panic, often stampeding over a cliff without a single one of them ever actually seeing the lion. This terrifying herd behavior leads to millions of investors blindly chasing speculative fads at the absolute top of the market or frantically fleeing perceived dangers at the absolute bottom, entirely abandoning any concept of robust fundamental analysis. We saw this exact same destructive psychological pattern during the infamous tulip mania in the Netherlands during the 1600s, where people traded their generational family estates for a single flower bulb because they were terrified of missing out on the wealth their neighbors were seemingly generating. We saw it during the catastrophic dot-com bubble of the late 1990s, where retail investors poured their life savings into companies that had no revenue, no product, and no business plan other than a .com domain name. And we saw it again during the post-pandemic meme stock craze. The story is always the same, only the technology changes. The crowd moves not based on intrinsic value, discounted cash flows, or macroeconomic realities, but based entirely on the rapid movement of the frightened person. standing next to them. In today's hyper-connected, algorithmically driven social media age, this dangerous herd effect is magnified tenfold. A single viral post on a major platform can trigger a multi-billion-dollar shift in institutional capital in a matter of milliseconds. However, while the mainstream headlines desperately suggest chaos and imminent destruction, the smart money, the institutional titans, who quietly move global markets, recognize the massive, underlying currents of opportunity flowing beneath the noise. This is where the contrarian perspective becomes not just an intellectual exercise, but an absolutely invaluable tool for wealth generation. Consider the current, surprisingly bipartisan push in the legislature to completely rebuild the nation's crumbling national parks and public lands, coupled with massively growing coordinated industry support from major outdoor recreation companies. This legislative movement signals a robust, deeply sustained financial commitment to infrastructure, spending that extends far beyond the petty, short-term squabbles of the current political cycle. The highly publicized repairs of the reflecting pool in Washington, D.C. may seem to the average cynic like just another example of a ballooning government cost that sparks public outrage. But to a sophisticated, macro-aware investor, it is a glaringly obvious signal of a much larger global trend. Governments across the entire globe, from North America to Asia, are aggressively turning toward the massive development of physical assets as the primary mechanism to stimulate sluggish domestic economies, combat structural unemployment, and physically project national strength. In an increasingly multipolar world, this macro shift creates an incredibly compelling, long-term structural investment thesis for infrastructure-related sectors. We are talking about the massive, unglamorous companies that actually make the modern world function. Heavy construction firms, advanced materials, manufacturers, specialized engineering conglomerates, and highly lucrative public-private partnership vehicles. History repeatedly shows us that, during periods of great chaotic geopolitical transition, those who actually build the physical foundations of the new paradigm often reap the greatest financial rewards. Think back to the absolute height of the Roman Empire, when the distant borders were under constant, brutal attack by barbarian tribes, and the silver currency was being rapidly debased by corrupt emperors in Rome. The empire did not stop building. They continued to lay down their famous, highly engineered stone roads. Those physical roads outlasted the emperors themselves, facilitated massive leaps in international trade, and generated wealth for centuries. After the political structure collapsed, or consider the 1950s in the United States. Following the devastation of the Second World War, and amidst the terrifying rise of the Cold War nuclear threat, President Eisenhower initiated the interstate highway system. It was arguably the largest public works project in human history. It wasn't just about moving troops. It fundamentally created the modern domestic logistics industry, birthed the concept of the suburb, and generated trillions of dollars in downstream economic value. Today, we are entering a very similar capital expenditure supercycle. Infrastructure real estate investment trusts, or REITs, are currently trending upwards, steadily reaching index levels of 1,210 precisely because the institutional market realizes that, regardless of who sits in the political seat of power, the crumbling bridges must be rebuilt. The electrical grids must be modernized. To handle the demands of artificial intelligence data, centers and the ports must be expanded. This is an unstoppable multi-decade megatrend. Furthermore, as investors looking to the horizon, we must directly address the rapidly evolving digital frontier. The impending, highly anticipated Senate Banking Committee vote on a major, comprehensive crypto regulatory bill represents an absolutely critical watershed moment towards achieving genuine regulatory clarity for digital assets. For the sophisticated institutional investor, this isn't just about engaging in wild price speculation on dog-themed meme coins. It is about the fundamental institutionalization of an entirely nascent, highly disruptive global asset class. Bitcoin is currently sitting at a powerful support level of $62,500, not because of retail hype, but fueled entirely by the deep, institutional anticipation of this incoming regulatory framework. You must understand how massive pools of capital actually operate. The giant pension funds, the sovereign wealth funds, the massive life insurance companies. that control trillions of dollars in global wealth, cannot legally or functionally invest in an unregulated Wild West frontier. They require crystal-clear rules regarding legal custody, tax compliance, and fiduciary duty. When the definitive rules of the game are finally written down and codified into law, the massive floodgates of institutional capital can finally open. This legislative event permanently unlocks significant, sustained capital flows and drastically reduces the regulatory risk premium that has historically suppressed the valuation of the entire sector. It marks the permanent transition from an experimental, highly volatile frontier technology to a governed, globally recognized financial province. We saw this exact same dynamic play out in the 1930s. Following the horrific, devastating stock market crash of 1929, the public completely lost all faith in equities. The market was viewed as a rigged casino. It wasn't until the creation of the Securities and Exchange Commission in 1934, paradoxically spearheaded by Joseph Kennedy, a man who had famously exploited the very loopholes he was hired to close, that institutional trust was finally restored. Regulation didn't kill the stock market. It legitimized it, paving the way for a century of unprecedented wealth creation. The incoming digital asset legislation will serve the exact same historical function. So, knowing all of this, how do we practically navigate this terrifying and lucrative environment? How do we apply what we call the Titan's Playbook? The current broader market sentiment is locked in a highly precarious equilibrium. It is a constant, exhausting tug-of-war between a desperate, cautious optimism and a deep-seated, entirely rational macroeconomic apprehension. To survive and thrive here, we strongly recommend a highly disciplined, strategic asset allocation model consisting of 50% equities, 35% highly secure, safe haven assets, and exactly 15% in liquid cash. This is not just a random, arbitrary set of numbers pulled from a textbook. It is a battle-tested financial architecture built specifically for absolute survival and aggressive growth in a highly volatile, inflationary environment. To effectively deploy your capital right now, you must ruthlessly prioritize sectors, demonstrating proven, undeniable resilience against erratic political volatility. Strategic, long-term allocations to broad infrastructure exchange. Traded funds, such as those trading under the tickers, PAVE or IFRA, are incredibly prudent. These specific funds hold the very companies that stand to gain, the most from multi-year, multi-trillion-dollar government spending commitments. They hold the heavy machinery manufacturers, the copper and aggregate miners, and the specialized construction firms that are largely insulated from the daily, short-term political squabbles on cable news. The money has already been appropriated. The projects are moving forward regardless of the daily news cycle. Furthermore, you must recognize that the nature of warfare has fundamentally changed. Cybersecurity ETFs, such as those found under the tickers HACK or BUG, are absolutely critical portfolio components. As kinetic geopolitical tensions rise in the physical world, the actual battlefield has rapidly moved to the digital realm. Sovereign state actors are constantly attacking critical infrastructure grids, banking systems, and healthcare databases. Ensuring data integrity and robust national security are now the absolute, non-negotiable top priorities for every single major multinational corporation and government on the face of the earth. Cybersecurity is no longer an optional IT expense. It is a mandatory cost of survival in the 21st century. For essential defensive ballast against the inevitable market shocks, utilities ETFs like XLU or VPU offer incredibly stable, highly predictable cash flows and consistent dividend payouts. They provide a massive, reliable hedge against broader market turbulence because, regardless of what happens in the global economy, people will always pay to keep their lights on and their water running. And, given the dark realities of the current geopolitical landscape, we cannot ignore the defense and aerospace sector. ETFs like PPA or XR capture the massive exponential growth driven by rapidly heightened global defense spending in a world where historical ceasefires are openly acknowledged to be on life support and where major global powers are actively rearming at a pace not seen since the Cold War. The companies that design and manufacture advanced defense technology become absolutely essential, recession-proof investments. But beyond simply analyzing what specific assets you buy, You must focus with absolute obsessive discipline on exactly how you buy them. In this current environment of incredibly heightened economic uncertainty, the psychological discipline of dollar cost averaging is an absolutely indispensable, non-negotiable risk management tool. By systematically and consistently investing fixed monetary amounts over regular intervals of time, regardless of whether the market is screaming higher or violently crashing, you effectively mitigate the massive psychological danger of market timing risks. You mathematically smooth out your average purchase prices, completely removing the dangerous emotion of the affect heuristic from your investment process. You must also maintain strict, uncompromising position sizing. You must never ever let one single speculative asset or highly concentrated sector dominate your portfolio to the point where a single, unpredictable political event or sudden legislative change can completely wipe out your net worth. Establish clear, unemotional exit strategies before you enter a trade. Use automated trailing stop-loss orders for your more highly volatile equity holdings to lock in profits and mechanically cut losses. And always preserve a strategic, highly liquid cash reserve. This 15% cash allocation isn't just a passive safety net, sitting in an account losing value to inflation. It is your financial ammunition. It is the crucial strategic fuel that allows you to aggressively step in and capitalize on massive opportunistic market corrections when everyone else on the street is panicking and liquidating their assets at fire sale prices. We must also consciously look outward and utilize the global shield. While the United States market obviously continues to offer unparalleled leadership in technological innovation and deep capital liquidity, maintaining a purely domestic focus risks completely overlooking massive, uncorrelated growth opportunities abroad. However, you must be incredibly selective and analytical. Look specifically for developed markets that feature robust, transparent rule of law, governance, or identify rapidly emerging markets that demonstrate clear, undeniable economic reform trajectories, combined with strategic hard asset resource advantages. The ultimate key to global investing is to meticulously weigh the inherent geopolitical risks against the massive potential for asymmetrical, uncorrelated growth. As we summarize the immediate action plan for the current macro environment, there are incredibly clear definitive do's and don'ts that separate the titans from the retail herd. Do significantly increase your strategic exposure to clean energy technology, ETFs like ICLN or QCLN precisely, when new massive legislative packages are passed. These massive bills provide long-term, highly lucrative tax credits and systemic subsidies that indicate a permanent, sustained policy support vector that guarantees a massive influx of capital over the next decade. Do aggressively initiate defensive positions in agricultural commodities, ETFs like DBA or RJA, if you see geopolitical tensions in major, vital, food-producing regions begin to escalate. Agricultural commodities are the ultimate, historically proven inflation hedges, because the global demand for basic caloric intake is completely inelastic. On the other hand, you must strictly adhere to the don'ts. Do not, under any circumstances, make massive, highly concentrated investments in speculative industries, whose entire financial fortunes are tied to the unpredictable outcome of a single election cycle, or the passing of one specific, highly contested legislative proposal. These are not investments. They are highly speculative, binary bets that carry immense, unquantifiable event risk. If the political landscape shifts, even slightly contrary to your rigid expectations, the resulting capital loss can be incredibly rapid and completely irreversible. You must never let inflammatory political rhetoric or the emotion of the crowd override your dedication to fundamental mathematical value. In the end, as you navigate this complex financial architecture, we must constantly remember today's core warm insight. Amidst the constantly shifting sands of global politics, the erratic policy decisions of central banks, and the terrifying noise of the 24-hour news cycle, it is the enduring, unstoppable currents of human ingenuity, technological adaptation, and raw economic necessity that ultimately chart the true course of long-term value creation. Throughout human history, global financial markets have consistently demonstrated a truly remarkable, awe-inspiring resilience. They have successfully navigated countless devastating geopolitical crises, catastrophic world wars, crippling pandemics, and massive domestic policy upheavals, Severe short-term volatility is an absolutely inevitable companion to any meaningful structural change, but the fundamental underlying drivers of innovation and adaptation always consistently prevail. This profound historical perspective should completely reinforce the wisdom of maintaining a highly disciplined, deeply researched, long-term investment strategy, overreacting to the fear-driven, short-term speculation of the uninformed crowd.